It's something we don't often think about, but there are these huge, invisible systems that are constantly standing guard over our savings. Every single day, banks are moving unbelievable amounts of money. And behind all that action is this really complex framework designed to keep the entire financial system from, well, falling over. Today, we're going to pull back the curtain on the Reserve Bank of India's playbook for managing one of the biggest dangers in banking, credit risk.
Okay, so here's our game plan. We're going to start with the absolute basics. What is this credit risk thing anyway? Then we'll get into the RBI's three-part framework for keeping things safe. From there, we'll see how a bank actually gives a borrower a financial report card, how they look at the big picture, the whole portfolio, and finally, we'll tie it all together and see why this stuff is so critical for, well, all of us. All right, first things first. Before we can even begin to talk about the solutions, we have to get a really clear handle on the core problem. I'm talking about the fundamental challenge that every single bank on the planet has to solve. At its heart, it's actually pretty simple. Credit risk is just the chance that a bank lends out money and doesn't get it back. Now, this could be because a person or a company just isn't able to pay, or, hey, sometimes they might be unwilling to. It's really the foundational risk of the entire business of banking. And it's really important to realize that this risk shows up in a ton of different ways. We usually think of a simple car loan or a mortgage, but it is so much broader than that. It could be a giant corporation defaulting on some complex financial deal, a stock trade that just fails to go through, or even an entire country suddenly saying, nope, no money is leaving our borders. Credit risk is basically hiding in almost every corner of a bank's operations. So, with risk lurking in pretty much every corner, how do banks build a fortress to protect themselves? And just as importantly, their depositors? Well, the RBI lays out a master plan, a framework for safety that's built on three core components. The logic here is actually super clear and makes a lot of sense. It all starts at the top, right? The board of directors sets the rules of the game. That's the policy. Then, the bank builds the team and the whole organizational structure to actually enforce those rules. And finally, you get down to the daily grind, the operations and systems that are constantly measuring and monitoring the risk on the ground. It's a really smart, top-down, systematic approach. Now let's take a look at the people behind this whole process. See, everything starts at the very top, with the board of directors. They set the tone, they set the strategy, but the entire hierarchy you see below them is designed around one absolutely critical principle: independence. The people who manage the risk have to be separate from the people who are making the loans. You just can't have the sales team grading their own homework, right? And this chain of command is exactly what makes the system tick. You've got the board setting the big vision, a board-level committee then integrates that vision. After that, you've got a committee of top executives, the CRMC, to put the strategy to work on the ground. And maybe the most important piece of this puzzle is that completely independent department, the CRMV, whose only job is to measure and control risk across the entire bank, completely free from any pressure to just go out and make new loans. Okay, so we've got the structure in place. But how does a bank actually look at a company that's asking for a loan and boil all that complexity down to a clear, objective risk score? How do they go about creating that financial report card? Well, I can tell you it's definitely not just a gut feeling or a simple thumbs up or thumbs down. The RBI's guidance really pushes for a structured, methodical process that turns all the complicated realities of a business into a single, standardized rating. The process for this is, as you can see, incredibly detailed. Analysts take in a huge amount of information, all the different business and financial risks, and they systematically refine it. They decide how important each risk is, break it down into these smaller, measurable pieces, score each little piece, and then add it all up to get to that single final rating. The whole point is to be systematic and consistent every single time. And here's just a tiny snapshot of that puzzle in action. The bank's internal rules might say something like, okay, if a company's operating margin is above 20%, it gets a score of 2. Or if its debt-to-equity ratio is in a certain healthy range, it gets another score. They do this for dozens of different parameters, and it's how they turn a really complex financial statement into a simple, comparable number. But here's the thing. A single loan is just one tree. A great loan to a great company is fantastic, but modern risk management is all about understanding the health of the entire forest, the bank's whole portfolio of loans. Historically, banks just set simple limits, right? They'd say, we won't lend more than X amount to this one company. But that's a very reactive way of thinking. The modern approach, which is what the RBI is pushing for, is much more proactive. It looks at the whole portfolio and asks a much, much smarter question.
How might a bunch of different loans go bad at the same time? And that gets us to this core idea of portfolio correlation. So, a steel company and a cement company. They seem totally different, right? Different industries, different management teams. But what happens if the government suddenly slashes spending on big infrastructure projects? All of a sudden, both of those companies could get into deep trouble at the same time. Understanding these hidden connections is the absolute key to modern portfolio management. So, we've gone through the policies, the structure, and the techniques. But let's bring it all back to the most important question of all. Why does any of this actually matter? What does it mean for you and me and for the money that's sitting in our wallets?
Look, this stuff isn't just about banks protecting their profits, not at all. This system is the #1 line of defense for our deposits. It makes sure the entire economy has a stable foundation to stand on. It also leads to fairer pricing, so safer borrowers can get better interest rates. And crucially, it forces banks to be proactive, to spot trouble brewing on the horizon before it becomes a full-blown crisis. And that kind of leaves us with a final thought to chew on. This whole framework is our best defense today. It's a sophisticated system that's been built from decades of experience. But financial risks, they are constantly changing, constantly evolving. So the great challenge for banks and for regulators is making sure this playbook is always one step ahead of whatever the next crisis is. The story of taming risk? Well, that story is never really finished.